International Monetary Fund is seeking more reforms to be carried out by Egypt's government prior to its first review of its $3 billion rescue program, Bloomberg reported, citing people familiar with the matter. Additionally, the fund wants to see more state assets privatized and real currency flexibility in Egypt. In a news conference last Thursday, the IMF's head for the Middle East, North Africa, and Central Asia stated that the flexibility of the exchange rate is the best way for Egypt to protect its economy from external shocks. In Kenya, as a result of low property valuations caused by the nation's challenging economic situation, Kenyan banks are turning to repeat auctions to expedite the sale of foreclosed vehicles, homes, and land at reduced prices. The increasing percentage of debts whose principal and interest have not been paid for at least 90 days have upset the lenders, who are now ordering auctions to repost bids for seized property. Due to variables including devaluation and limited liquidity in Kenya's weak economy, some of the properties that are being re-advertised have seen a decline in valuation, resulting in reserve prices that are now more comparable to the offers that were previously received. Still in Kenya, the amount of cargo handled by Kenya's Mombasa port has decreased for the first time in 5 years, according to participants who have pointed to a number of issues, including, competition increasing from Dar es Salaam. According to figures compiled by the Kenya National Bureau of Statistics, the port's overall cargo throughput decreased from 34.76 million metric tons the previous year to 33.74 last year. The volumes fell to their lowest point since 2018, when they were at 30.92 million metric tons, a 2.93% year-over-year decline. The government of the Republic of Kenya, through the National Treasury, is considering accessing the international capital markets. This is intended to happen before the end of the fiscal year 2023-2024. That's July 1st through June 2024, to issue a sovereign bond. Joining us to discuss further, Churchill Ogutu in Nairobi. He's an economist with IC Asset Managers. Churchill, good afternoon to you. Thank you so much for joining us. I wanted to first start with this bond. Kenya's external debt is, as of January, looking at $37 billion. Is now the best time to be exploring another bond?
Good morning, Reuters. I think, let me put it straightforward. This bond that is being explored is for liability management operations. We have a $2 billion Euro bond that is maturing next June. So the expression of interest essentially is now to find ways of retiring this particular bullet maturity. So I think what will make it successful is how the authorities will go out there and emphasize the fact that this is a liability management operation, and it is not a new borrowing. So that will be the decisive factor. Right now, the international financial conditions are really tight, so it will also be a wait and see, because ultimately this bond needs to be floated sometime in the next financial year, which is starting July this year. So it will be a wait and see for the government to see as and when the international financial conditions is up, so that they cannot be able to come to the international market. So those two factors will be quite critical once Kenya goes to the international market.
Do you have any worries about so we go from I guess liability management? Okay, that's fine. Lending rates in Kenya, I think as of February, 13.06. I mean, if there's more borrowing down the line, won't the government at some point have to raise rates to keep attracting capital into its shores? Or am I getting that wrong? How does that work?
Yeah, so just to put it in some context is that, yes, lending rates are going up, but if you look at on the demand side, that is the credit to the private sector. In growth terms, it has started to taper off. At some point, it peaked at 14.5%, and now we started seeing it going to levels of 11%. That is on a year-on-year basis. And that tells us that the cumulative 250 basis points rate hikes that have been done by the Monetary Policy Committee since May last year has started having an effect. So just to put it into some nuances, in regards to the portfolio debt flows that will come because of this cumulative rate hikes, what you're saying is there's a sense of financial repression in the sense that the yield curve have not adjusted at least to absorb these 250 basis points. So that is one issue. The other issue is that FX convertibility is still a big risk, in the sense that you can't expect foreigners to come to the Kenyan market, and yet they are giving us dollars, but at the point of exit, it will be an issue exiting. So that is also some of the nuances that potentially might not see flows coming to Kenya, in as much as rate hikes have already been implemented by the authorities.
All right, so that's capital flows. Let me ask you about trade flows and the Mombasa port. We're seeing more competition coming from Dar es Salaam over in Tanzania. What's the reason for the lower cargo volumes at Kenya's Mombasa port?
Yeah, there's been some logistical constraints in the sense there have been some roadblocks, road tolls in a number of the roads that as they move their goods from Mombasa through the Kenyan Western port and into the neighboring countries. Also, the road situations are not quite good, and also the multiple border charges. So those are some of the logistical constraints that some of the importers are finding. And also the distance. I find that the going for the importers passing their goods through the Mombasa port, that is the northern corridor. The other option is the eastern central corridor. So the northern corridor, that is through the Mombasa port, is quite longer. That's 1,700 kilometers, whereas the central corridor is 400 kilometers shorter than that. And also the political risk that is still rearing its ugly head in Kenya, whereby 2 days in a week over the course of last month, we saw that there's been some demonstrations because of the polls that happened last year. So all these things are coming into a tow and leading to a reduction in the volumes that is passing through the Mombasa port, and also, or rather, the preference towards the Tanzanian ports rather than the Kenyan ports.
All right, thank you for that breakdown, Churchill. Let me quickly get to Egypt. What do you make of the IMF stance on the conditions that are being attached to that second tranche of this loan that they're looking for?
Yeah, so actually it's the first review. So the deal was signed in December, $3 billion, which is over 46 months to Egypt by the IMF. So there were some criteria that Egypt needed to have done. So there was the first review, which was supposed to be mid-March. So that has been delayed. And what we're hearing from the news flow is to the effect that the IMF would like to see some of these reforms being enacted, and we've seen devaluation events happening, at least 3 over the course of the last 12 months. In January, we saw the last one, but still, if you look at the Egyptian pound compared to where the market expects the pound to be in the next 12 months, there's still a bit of some premium. So the market still expects some flexibility on the currency. So that's one, and also on the structural reforms, the privatization plans. So Egyptian authorities came up with a plan of privatizing 32 state-owned entities via IPOs and also via the foreign direct investments. So we haven't seen much progress around that. So potentially we could, the IMF is putting its feet down and saying that it would like to see some progress around the privatization reform, so that as a precursor for it now to have its first review discussions with the IMF, with the Egyptian authorities.
Churchill, thanks for that. So the IMF is unpopular in some circles because of what some feel are stringent loan conditions. Do you think that's fair?
Well, I don't think that's a fair criticism at all. If you think of IMF as the fireman who comes to your house because it's on fire, I think the critics might be a bit less harsher on that. And also the conditions. If you think about it, the conditions are not imposed by IMF, but rather is negotiated between the IMF on one hand and also the authorities in any country that is facing or goes to the IMF for funding needs. So it's kind of, they sit down and then they come up with these conditions. So it's not that the conditions are imposed by IMF. So IMF is like the big brother who ensures that these conditions are followed through. And also with the IMF funding, it also unlocks some other financing from the multilateral lenders and also the commercial lenders. So I think that is not a fair criticism that IMF is quite harsh with these conditions.
Now, looking at the impact of COVID, now you've got this war in Ukraine. Egypt is, I think, a net importer of wheat and other, commodities. How fiscally fragile are these, import-dependent nations like Egypt?
Yeah, unfortunately, this external shocks brings the fragilities in the sovereigns that we have. So, for the case of Egypt, the direct one is because of the impact of COVID and also the war in Russia, in Ukraine. So, it has had the direct impact in terms of the importation of wheat. Egypt relies heavily on importation of wheat to supply to feed its 100 million population. So that's the direct effect. The other one is now in the sense that now the fiscus will be impaired in the sense that the government will now be forced to come up with fiscal measures to support the most vulnerable communities who are impacted by the effects of what's happening by the collapse in global supply chains or the negative impacts of that. So that is also the channels that are transmitting. But that said, we can't expect to see import substitution coming up with like a flicker of a light. So we could expect to see that probably some of these economies may diversify or might have even buffers, be it FX buffers or storage capacity, so that they cushion themselves in case of the rainy days that comes frequently.
Pretty much out of time, Churchill. Well, what's your outlook for I guess, Kenya and Egypt as far as their respective economies are concerned this year? Briefly, if you can.
I think they'll muddle through. For the case of Kenya, we have a protracted drought, which is still coming to an end. Our fiscus is not in the best position. But I think what will offset all these negative shocks will be services sector, which is running in positive steam, at least in the Kenyan context. For Egypt, I think it needs to come up with a privatization plan in line with the IMF program, and also have some flexibility. If you look at it, inflation is at record highs, 32.7 as at the end of last month. So it needs to at least ensure that there's some flexibility in its FX exchange so that you can be able to see inflation coming down. So I think if they are able to do a few things, those countries, we can be able to see some economic growth coming down, but largely muddling through in those two countries.
Churchill Ogutu, economist with IC Asset Managers, joining us live from Nairobi. Thank you so much for talking to us about the economies of Kenya and Egypt. Appreciate your insights as well.